and I had asked you to go through how you can create the same bull spread using the put options. Okay, so you can do it using the put options also. Okay, so now the next spread that we have to cover is the bear spread. So we have to consider the bear spread. Now the same thing, the bear spread can be created through call options as well as put options. Okay, now in bull spread we said that you will be gaining when the market will increase. In bear means like you are looking in for the market to decrease, you are looking for the downside. Okay, so bear is like people say you are bearish, it means that you are expecting that market to decrease. Now when you are expecting market to decrease, you would want to get the benefit. So here you will get the profit. So here you will get the profit if market decreases. So that is what your bear spread is. And since this is a spread, okay, so your profit as well as the loss potential is fixed. So maximum profit and maximum loss is fixed. Okay, in bull spread, if you see the bull spread diagram was this. So you had, okay, so bull spread was looking like this. So price increasing, okay, market increasing, profit is increasing. Here in case of bear spread, it is the different case. Here what you have is, if the market is increasing, you will be facing a loss. So this is your bear spread. So this is the stock price. Okay, so stock price is increasing, you'll make a loss, but if stock price decreases, you'll gain a profit. Okay, so since it's a spread, you have to create using two options. Okay, and one option will be bought, one option you will be buying, and one option you will be selling. So you'll be buying one option and you will be selling one option. So how we can create it? So in the previous case, in the bull spread, what did we see? That you have to buy a low strike call and you have to sell a high strike call. Okay, in this case of a bear spread, what you have to do? Let's say we are doing it through put. Okay, so here again, this is your homework, how we can create a bear spread using a call option. I will cover how you can create a bear spread using a put option. Okay, so let's say you have a X high, so strike higher, strike lower. So you have two options, two put options. So these are two put options, strike higher, strike lower. Okay, how you will create the spread? Okay, which one should be bought, which one should be sold? Okay, so premium higher, premium lower. Okay, which one will you be buying and which one will be selling? Okay, so think about it. When the market decreases, you will get the benefit. Okay, so when the market is decreasing, you will get the benefit and you have to pay premium. So please note that here the premium will be paid net. So net premium like will be paid. So it will be paid. So here the put you will be buying will have higher premium. The put you will be buying will be higher premium. So buying of put will be higher and selling of put will be lower premium. Okay, so we have some so Beneath has said that we will be buying a higher strike and selling lower strike. Okay, so when the strike is lower, okay, so what happens is, for put option, for a put option, if the strike increases, okay, what can be said about the, or let's say when the strike decreases, what can be said about the premium? It increases or decreases? When the strike price decreases, so let's take a put option where the strike is 100 and the strike is 200. Let's say the stock price is 300. Okay, if the strike is decreasing, the premium will be increasing or decreasing? So stock price is 300, you have got the right to sell at 200. Okay, you have got the right to sell at 100. Okay, so here both are not helpful, but let's say stock price I take it as 50. Okay, stock price is 50, you have got the right to sell at 100, you have got the right to sell at 200. That means you'll be benefiting from this guy more. So you'll be benefiting 150 here, you'll be benefiting 50 here. So this is better. So the strike price decreases from 200 to 100 is becoming, the premium will be decreasing. So we want to buy that one which has a higher premium. We want to sell which has a lower premium, because net we have to pay. So this is net we have to pay. So what will happen is we'll buy the put with higher strike. So buy put with higher strike. So this is you will be buying. Okay. This is you will be selling. So lower strike will be sold, higher strike will be bought. Let's see the current market, how it is. So today market yesterday market decreased a lot, but today if you see the market is like this. So let's see. Okay, we can take, let's say, Reliance only. Okay. So Reliance stock price is 744. Okay, so the current market price is 744. You have an expectation that market will be falling. So this is your expectation, and you want to create a spread strategy. Okay. So what you are thinking is, let me create a spread strategy. Okay. By the way, like, it's only 6 days remaining for the expiry, because the expiry is on 29th March. Okay. So you can think of taking exposure on April contract. So the current market price is 744. So what you are thinking is, you are thinking that Reliance share will decrease, okay, but it will not go below 700. So you are thinking that, okay, so there is a put available for 700. So let's see the premium for all of these 720. 700 is how much? 10, 13, 22, 32. 10, 13, 22, 32. So these are the premium. So let's say we want to create a bear put spread, okay, using this, and you are saying that, okay, I will buy, okay, let's say you are saying that you will buy 760, okay, or you can make it 740. That would, I think, will be better. Buy 740 and you will sell 700. So when you are buying 740, premium has to be paid 22. Selling this, so premium has to be paid negative. So this is your initial cost. So this is your initial cost. Okay, that is, you are buying a higher premium, selling a lower premium stuff. So this is minus 12. Now let us see that we have to create a similar way we had created a diagram last time. Okay, I will be careful to draw a better diagram. Okay. Okay. So let's see the stock price. Okay. Okay. Let's say 660, 680, 690, 700. Okay. This is 700, 720, 730, 730, 750, 760. Okay. Now payoff from the higher strike payoff. Okay. Payoff from the lower strike. Then we have the net payoff. Please note that in net payoff will decrease the minus 12 which is there. Or if you want, we can have a gross payoff, and then we can have a net payoff. Okay. So at 660, what will happen? The higher strike is 740. The lower strike is 700. Okay. So if you see 660, what can be said? Both. So this option, you have the right to sell at 700. The stock has become, sorry, higher strike, right? You have the right to sell the stock at 740. The stock has become 660. So you will be getting a benefit 80 rupees. But so you have bought the stock, you will be getting 80. Here it will be 60. Here it will be 40. Here it will be 20, 10, 0, 0, 0. Anytime stock is greater than the strike price, there is no benefit. Okay. In case of lower strike, you have the right to sell at 700. So here you will get plus 40 plus 20 0, okay, 0 0 0 0 0, right? All of this will be 0. The gross, so but here please note that we have sold the option, okay, so we cannot say plus, right? So we have sold the option, it will be minus. So we have bought it, we have sold it, so minus. So your payoff will be how much? Gross payoff plus 40 plus 40 plus 40 plus 20 plus 10 0 0 0. Okay, net payoff, you have to deduct the 12 rupees that you had paid a premium, 28 28 28 8. This will be minus 2 minus 12 minus 12 minus 12. Okay, so this is the payoff that structure will look like. So if I draw it over here, so what we have, okay, so anytime the stock price is, if you see above 740, stock price is above 740, which is the higher strike, and stock price is below 700, you have the payoff is constant. Here the payoff is constant. So what we have is the payoff is constant. Okay, so this is your lower strike, okay, which is equal to 700. Okay, your payoff is 28. Okay, and then it will decrease. Okay, and payoff will remain constant at minus 12, which is this point. This point is x higher, which is 740. So any price above 740, the payoff is 12. Any price below 700, the payoff is 28. What is your break even? So this is your break even. What would be break even? Okay. So think about it, this is 28, right? So this is 28. Your stock has to travel 28 over here, because this loss is 28. You have to, stock has to travel 28 to make you break even. So this will be 700 plus 28. It should be 728. So if you see over here, at 720 you are making money, at 730 you are making minus 2. So if you go over here at 728, here it will be plus 28, here it will be 0, okay, sorry, plus 12, plus 12 0. So gross is plus 12, net is 0. So here 728 is your break even. So break even will happen at this point of time. Now again, like, you will be asked to find out the maximum payoff, maximum profit potential, the maximum loss potential, the break even price. So you have to know all of these formulas. Okay, again, as I said that we will I'm strongly against you remembering this formula. If it is at all it is coming in the examination, you have to create this type of table. It will not take much time. Even if it is taking time, it will be, you will be 100% sure on your capability. Okay, so what we say is max profit. Okay, so we have to do the reasoning. The max profit will come only when the stock price is less than the stock lower. So this is your stock lower. If the stock price is less than or equal to stock lower, you will get the maximum profit. Maximum loss, stock price is greater than or equal to stock higher. Okay, so just if you remember this is what I would say is you remember. Okay, because they will ask you question like to compute max profit, max loss, break even price. If you remember this, you will be able to compute. You will say that okay, the maximum profit potential will be at x low. Okay, so you will say that okay, if the stock is at x low, so I will get the benefit as, so first the benefit that I will get is x higher minus x lower. Okay, so x lower is 700, okay, x higher is 740. So this is the benefit that the first higher higher option will give. Lower option will give you nothing, 0, but you have to pay the premium. So which is the premium, net premium. So you have to say the net premium will be minus of premium higher minus premium lower. So premium higher was over here 22, premium lower was 10. So if you see 740 minus 700, so 740 minus 700 plus, sorry, minus 22 minus 10, so this is 40 minus 12, so it's 28. So what happens is, if you, somebody asks you what is the formula for max profit formula will be XH minus XL plus PL minus PH. So this is the max profit formula. Similarly, could you compute the max loss formula and give it to me? What is the formula for max loss? Okay, but before that you have to tell me like when the maximum loss will be achieved. Maximum loss will be achieved. So take the stock price equal to XH. We are saying that greater than equal to XH. Let's say we take it XH. Okay, give me the answer. What was the answer? Yeah, but I would want the equation. I would want equation like similar to what we have created this equation. I want that. Okay. So think about it when the stock price is equal to XH, first option, second option payoff, okay, and the difference of the premium. Okay. So first option will payoff is the first option means the higher premium. Higher premium payoff will be 0. Lower premium payoff will be 0. Okay. Correct? Higher premium payoff will be 0, lower premium payoff will be 0. This net premium is, so this is your loss. Okay. Or if you want to take it in the negative, XH minus XL plus PH minus PH plus PL. That is this, right? Beneath, this is the max profit formula. So this is the max profit formula. We are thinking about the maximum loss. So here if you see the maximum loss is 12, which is nothing but the premium which you have paid, the difference between the premium. So it is, so here if you see, if the stock price become XH, okay, if the stock price becomes XH, okay, both the option will pay 0 payoff. So both the option will pay 0 payoff. Payoff will be 0, payoff will be 0. The net premium will be the loss. So maximum loss will be PL minus PH. Okay, if you see, okay, the lower strike minus the higher strike in terms of your negative value. So if you see PL is 10 minus PH, so your loss is 12. Is it clear? Okay. So you have the maximum loss, maximum profit, and then next is you have to compute the break-even price. For the computation of break-even price, what we have is you have to compute this point. So this point computation is what I would say is, think of this as whatever is your x lower, okay, there you will be getting the, so this x, this is your x lower, okay, plus your maximum profit. So x lower plus your maximum profit will give you the break even point. So it is x lower plus the maximum profit. Okay. Now over here if you see the x lower plus maximum profit, if you bring it over here, xh minus xl plus pl minus ph, so these two will go. So your, so this is your break even point, not sorry break even profit, but it's break even point. So this is your break even point. Correct? Okay. Now